Is this the fabled soft landing? We finally reached rate cut nirvana with a 50 basis point cut on September 18th. This is the first rate cut since 2020 and comes after more than a year of speculation surrounding recessions, rate cuts, inflation, and unemployment statistics. But perhaps most shocking to Fed watchers was the projection for next year. The changes have caused quite a bit of excitement, pushing gold to new all-time highs once again. But with all this excitement, we ask, is the market getting ahead of itself? Or could gold go even higher? Stick with us and we'll review the changes taking place in financial markets and what it means for silver and gold. Before we begin, please take a moment to subscribe and support the channel. Thank you. A quick review of the Federal Reserve's recent activities and their dual mandate is in order. The Federal Reserve has a 2% target goal for inflation and a mandate for maximum employment. These two directives are often in direct contradiction, which is why it's important to have both mandates. It forces them to walk a tightrope and play a balancing act. Since the start of the tightening cycle, the Fed has been laser focused on inflation, while an overheated labor market played out in the background. There have been two major drivers of inflation over the past few years. The first is obvious. The stimulus checks handed out during the pandemic added a great deal of liquidity to the economy. And the second driver has been wage growth, which was a side effect of stimulus checks enabling workers to sit out of the labor market and pressure employers into offering higher wages. The Federal Reserve began raising rates in response. With the dual mandate to keep people employed and inflation down, they had to raise rates slowly to avoid creating a recession and causing people to lose jobs. And these two conflict because often when rates are raised, recessions and unemployment follow. For gold and silver investors, this is important. In a recession environment, gold tends to outperform while silver tends to be a mixed bag. Silver is an industrial metal, and if less goods and services using silver are produced, we would expect demand to wane and prices to fall. But the tightening cycle appears to be over, and no recession has materialized. Unemployment has ticked up over 4%, triggering the end of the Federal Reserve's holding pattern on the Fed funds rate. We mentioned this earlier. The Federal Reserve's dual mandate forces them to proceed carefully. In times past, the Federal Reserve has nearly always caused a recession by raising rates and driving unemployment up. But the recent rate cut may have saved us from repeating history. Gold has reacted in the most predictable of fashions. It's well documented that gold will perform best in environments with negative real interest rates. Although the Fed has shifted their stance, inflation is still above the 2% target and has been sticky at a higher level for months. With rates now falling and cheap debt on the horizon once again, the market is betting that gold will react accordingly. Driving the gold bull's optimism is the Fed's summary of economic projections, which contains a forecast for rates in 2025 and beyond. It seems the board is projecting rates to be between 3.25 and 3.5% by the end of next year. Only one board member has projected rates to remain above 4% by the end of 2025. This would be a 200 basis point decrease in the Fed funds rate, which is almost guaranteed to spur economic growth. As if that weren't enough, the Federal Reserve is likely to cut rates again this year. The board expects to end 2024 with a Fed funds rate at an additional 0.25% to 0.5% lower. With the US election on November 5th, the Federal Reserve will not be meeting again until November 7th. There will be one more meeting after that, and we can expect additional news on December 18th. With all this activity, gold has pushed its way well past $2,600 an ounce at the time of writing, reaching an all-time high just past $2,620 per ounce. If this is gold's ceiling, there will be a lot of disappointed analysts who have forecast gold breaking $3,000 per ounce and higher in the coming months. And this is always a question for investors. No one wants to buy an asset at the top of the market and be left holding the bag. There is understandable hesitation to invest in something that has reached a new all-time high. And yet, if we wait, we may miss the opportunity to buy at a lower level. It's possible that when gold crosses the $3,000 threshold that we will never see it in the $2,000 range again. No one has a crystal ball, which is why financial advisors usually recommend dollar-cost averaging strategies to reduce risk and increase returns. But silver is a potential sleeper. Silver has different characteristics than gold. It's nowhere near its all-time high, but it is trading near a decade high, currently over $31 per ounce. It's a more volatile asset than gold, but because silver's all-time high is near $50 per ounce and it tends to follow gold, we have some expectation that silver will have room to run in the near future. And as long as we continue to avoid a recession, then silver has plenty of tailwinds, as government spending slants towards green energy initiatives that consume a great deal of silver. And rate cuts are likely to increase consumer demand for items that use a great deal of silver as well. The one note of caution we may provide is that it's possible the planned rate cuts do not materialize, and this would impact the rosy future we've painted for silver and gold here. There are some who believe the Federal Reserve has cut rates solely for political reasons, and they'll go back to a tightening stance after the November 5th election. The reason is due to the timing, the size of the rate cut, and the sudden change in direction. This is the very last opportunity to cut rates before the election. In the July 31st FOMC press conference, a reporter from MNI Market News asked Federal Reserve Chair Jerome Powell, is a 50 basis point cut as a first cut at all likely or even on the table? And Powell's response was, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now. His tone, demeanor, and body language at the time, shaking his head no while responding, indicated to viewers that a 50 basis point cut was not in the cards. And then of course it happened. We noted this in our last video regarding gold and elections, but the Federal Reserve has a lot of power to create a temporary boost in the economy at a pivotal moment during this election cycle. If they wanted to create maximum impact, they would make a surprise cut and release rosy projections, which is exactly what happened. Reporters asked Powell in the September meeting for clarity as to why they decided to cut when they did and the amount they did. After all, inflation had ticked upward and the timing looks a little suspicious. But the back and forth between Powell and reporters revealed some interesting nuggets, with Powell asserting the Fed's right to change the plan at any given moment based on how they perceive the data. He said, we can go quicker if that's appropriate, we can go slower if that's appropriate, we can pause if that's appropriate. Powell has been very clear that he is proud of the committee's independence from politics. So it's likely this rate cut is a true pivot away from the tightening cycle. But it's easy to see why, given the timing and context, some remain skeptical. If rate cuts continue after the election, then gold and silver are likely to continue an upward march, and we can put the suspicions to bed. But what do you think? Are we done with the surprises from the Federal Reserve, or do we have more in store? Are these rate cuts for real, and will gold continue to rise? Leave some comments below and let us know what you think. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.